Well, I am one of the lucky people that gets to work with my family. My dad is Danny Cochran, and when I was here in school working on my degree, I got my degree in finance and then accounting and econ minors. I made it very well known to him I wanted nothing to do with taxes. When I got older, I just wanted to do financial planning and investments, and that was all I wanted to do. When I graduated, I went and worked for a broker-dealer in Dallas for 3 years, and he said, I had the opportunity to come back and work with him, and he said, but you gotta learn taxes. And so I said, okay, we'll learn taxes. And so when most people see our tax return, to them it is, what does my balance do, what's my refund? When I look at the 1040, I see questions about what is my retirement, what can we do for small business planning, what can we do about college savings, tax deductions, obviously, and health care. So a lot of these things come into play other than what's my refund or my balance due. And we're going to look at, this is your first 2 forms of your tax return, and hopefully everybody got one of these, because I know that on the PowerPoint it is little bitty font, so I don't expect you to read it off of here. But what this is our cover sheet that we have on our tax return. And you'll have this on the front, and then you'll have several forms and schedules that follow, and the other forms and schedules that follow show how we arrived at the calculation, and then that final number is put onto here. Our top section right here, we have basic information, your name, your filing status, your exemptions. This section right here is where all of our income gets reported to. And then this bottom section is any adjustments. These adjustments are going to be direct subtractions off of our income. Our bottom number right here is what's called our adjusted gross income, or our AGI. And this becomes a very important calculation for us in the tax return because there's a lot of numbers that depend on what our AGI is. So our goal is either through income or adjustments to try and get this as low as possible for those other calculations. The second page, this little group right here, are taxes and credits. And this is where our standard deduction or itemized deduction, where that comes into play. This little group right here is going to show any other taxes that we have to pay. And down here we have our payments. And that's going to be our withholdings or any federal or estimate payments that we would have made, or quarterlies. And then down here, do I owe anything or do I get a refund? So that is just a general overview of what that form looks like. Our wages, there are lots of opportunities as far as our wages where we can take advantage of some planning opportunities. So this is going to be line 7 on the 1040. And the first one is going to be our retirement plan contributions. What we contribute to our retirement plans are tax deferred, meaning they get subtracted off of our wages, and then when we take that distribution in retirement, then it becomes taxable to us in retirement. We also we get an employer contribution as well to our retirement savings, and we want to look at, if we are contributing, how do we have those funds allocated? Are they working the best for us to prepare us for retirement? And then once we have that portfolio set up and our different percentages, we want to look at rebalancing and making sure everything stays in portion in that retirement plan. And here we've got our different types of plans that we have. And our limits have increased from last year, max contributions. Down here are 403B that we have with OSU. Our max contribution is $18,000. For 50 and plus, you can make an additional $6,000 contribution. And you can see from here, it went up from what we had in 14. And also here, if you've had been with OSU for 15 years, you can do an additional $3,000 contribution as well.
What's the difference between a 457 and a 403?
It's going to depend on the type of employer. A lot of more of our corporates, and not necessarily like state governments, those are going to be 401ks. The 457 is also going to be, it would just be kind of depend on like the entity in and of itself and how it was operated, whether it's a corporate job or nonprofit or state, that type of thing, so.
That's what I have currently. I have a 457.
The 457? So it's not the 403B?
You can get either one.
Oh, okay, okay.
Either one.
Well, we've got the same as far as our contribution amounts. I was trying to remember, is that split or do you contribute to both of them?
I just have the 457, but I know you can get either one.
Okay, okay. I can look up more of the specifics for you if you want. Okay.
Now, can you have both a 403 and a 457 at the same time with the same employer?
We are going to be limited on, you can't do 18,000 in both. You'd want to look at contributing to the one that is, they both get matched, correct?
No, if those are just plans that we choose to put in.
Oh, okay,
money.
okay. If you have an option of one that gets a match, that would be something you'd want to look at first to get that employer match. That would be a good one to look at, and then secondly, look at what the investment options are.
Maybe it's the 403B that OSU puts into, and then you can pick between the 401 and the 457. I know there's one we.
Okay, okay. The other thing about our retirement savings is you can make these contributions, increase them during the year or decrease them. Hopefully you don't decrease them, but most of these updates can be made throughout the year. You don't have to wait for your benefit renewal in November. A health savings account, this is one that you'd have to wait till November when you sign up for benefits. But what we get here is similar to our retirement contributions, where it gets subtracted off of our income, and then distributions are excluded or not taxable if they're used for qualified medical expenses. And that would include prescriptions, copay, glasses, contacts. Over-the-counter medicine is not included unless you have a prescription for it. But here's what we can look at for our contribution limits. In 2015, our single 33.5 is our max, and for a family 66.5. We have that over here. It's 55 and older catch-up contribution of $1,000, and this was increased from last year. In this plan, if you don't use that money, then you can carry it forward and keep carrying it forward to the next year. A flex spending account, it is similar to a HSA. It has a modified use it or lose it rule. So a lot of times you've heard of people that they've got to use up their flex savings account or flex spending accounts because they're going to lose that money. You can carry forward $500 per year is what you can carry forward. And we've got two options. You can do a flex or you can do a dependent care. And with our dependent care, for a married filing joint return, you can do $5,000. That did not increase. And if you did a married filing separate return, we're at $2,500 there. And as long as those expenses are used for qualified child care or qualified medical expenses, again, they're not included in your gross income. So I put together a sample W-2 of what this would look like. In this situation, I said that married with 2 children, $50,000 in salary, and we did $5,000 toward dependent care, and we did 6% to 401k, and then 3% to HSA. And so here's what you can see, your W-2, probably you've already received that by now. Right here, our wages is at $42,000. That is our 401k contribution and our dependent care. That $8,000 there, you can see, reduces our taxable wages by $8,000. And our Social Security wages and Medicare, that does not get reduced. And here's over here where we have dependent care come in box 10, and box 12 is our 401k contribution. And just as a very basic return, I ran it with just this information, and they were expecting a refund of about $2,900. And I went through and re-ran it, made wages $50,000, and they were expecting a refund of about $1,700. So that just gives you an idea as far as looking at some of these options and how that will affect your wages. Now, this doesn't mean that everybody that does this, you're going to increase your your contribution by $1,200. It's very specific based on family, but this was a very simple example. Our next line items are interest income on line 8 and ordinary and qualified dividends, line 9. With our interest income, we want to review the purpose of these accounts. Is it being used for a short-term emergency, long-term emergency? Is it going to be used for future large purchases, such as a down payment on a house, a car, that type of thing? If it's a short-term emergency fund, I think it's a good idea to have it in a savings account at the bank. If it's a long-term emergency fund that's more like 3 to 6 months, then we may have some option into looking at some investments that maybe would not have a taxable result for us. And what these obviously are gonna come from our savings account, money markets, bonds, CDs, and this is gonna be taxed at your current tax rate. So whatever tax bracket you're in, this is what it's gonna be taxed at. If we receive dividends from mutual funds or stocks, sometimes we see situations with the dividends, it's inherited from a grandparent and you don't necessarily know what to do with it, and that particular company meant a lot to that grandparent and you don't necessarily want to sell it. But it's important to review, why are we holding that position that we are, because we may be paying money and taxes on something that we're not using. If we have a short-term capital gain, that is going to be meaning that we've held it less than a year, then that gets taxed at our ordinary income rate or our current tax bracket. If it is a long-term capital gain, then it gets taxed at this following. So if you're in a 15% tax bracket or below, it's a 0% long-term cap gain. If we're in the middle brackets, then we get taxed at 15%, and if we're in the highest tax bracket, we get taxed at 20%. Business income. Does anybody's spouse self-employed? Okay. So our line 12, one of the biggest areas that we see that are subject to our IRS audit is vehicle expense. And a lot of that's because it's hard to keep track of miles and people don't like doing it. And when you're going to elect your vehicle expense, you either want to use actual miles or actual expenses. Our mileage rate went up to 57.5 cents per mile, up from 56 cents in 2014. With our miles, there's different ways you can keep track of those. I know there's different apps on your phone you can get. I'm a little hesitant to use the apps. The IRS can go back and audit a return for up to 3 years, and they can send you correspondence within that 3 years saying we need documentation proving your miles, and you have to be able to get that information to them within 30 days. And if you keep an app on your phone, unless you have an account you can pull up online, chances are you've probably lost that phone. It doesn't carry forward to your next phone, and you may not be able to pull that information back up for them. So I would look at using a spreadsheet or a calendar, something like that you can keep in your records for 3 years to be able to provide to the IRS if they should have any questions. Our depreciation, in our section 179 depreciation, this in particular means if you buy a piece of equipment or car or a big piece of something besides just regular like office supplies, you can elect to spread the cost out over several years, or you can take it all up front. And this year we didn't quite know what to expect in 2014, how this was going to play out, up until December 19th at like 7 o'clock in the evening, which was the Friday before Christmas. Our Congress and President passed into law and extended. Currently, the Section 179 depreciation was set for $25,000 for this year. In 2013, it was $250,000, and so they signed into law on December 19th that you could take up to $500,000, which is kind of hard if you're trying to plan your business and buy equipment. If you find out December 19th, and the law expired December 31 of 14, so it was really only in place for 12 days. So I don't have any information as far as what to expect for 2015 yet. I guess we'll wait till December 19th again. But that was an area that was hard for our business owners to figure out how to do some tax planning around this year. Meals and entertainment, 50% deductible. And business use of the home, it must be used exclusively just for that business. I know I go home and I take work home and I sit at my dining room table. Well, unfortunately, I cannot count that as a home office because we also eat there and different things like that. And what's kind of interesting, how the IRS looks at your end of the year bottom line for your business is different than your year-to-date profit and loss, that type of thing for your own books and records. And some of that comes into play with our mileage and our only 50% of our meals and entertainment being deductible. Line 15, our IRA distributions. This is if you have changed jobs in the past, you and hopefully we're contributing to a retirement plan at those jobs, you have the opportunity to transfer those. Most companies or employers will allow incoming transfers into their plan if it's the same plan type. And you want to try and roll those over and not take a distribution out of those, especially if you're under 59 and a half, because as soon as you take a distribution out of it, everything is fully taxable. If you're under 59 and a half, you get hit with a 10% early withdrawal penalty. If for whatever reason your new employer won't allow you to take that into their plan, then you can move it into your own account and manage it separately. Another thing that may want to consider would be looking at a Roth conversion. You have a IRA account and then you have a Roth IRA. An IRA account operates like our 401k, that it's tax deferred. With our Roth account, you go ahead and you pay the taxes now, and then when you take distributions from it in retirement, those distributions are tax free. So you can make the election to do what's called a Roth conversion and convert that qualified money over into Roth money and go ahead and pay the taxes and let that grow tax-free. Our adjustment sections, lines 23 through 37, are educator expense. This was another item we were afraid was going to go away, but it got extended. $250 for educator expense. Any of us that know teachers know they spend way more out of pocket than $250, but unfortunately that's all we get. If we are self-employed, line 27 through 29, our self-employment tax, half of that is an adjustment for us. Our contributions into SEPs and Simples and qualified plans are, if you're self-employed, you have a whole different option as far as your retirement plans available to you. And in that SEP plan, for example, you can contribute up to $53,000 per year in that particular plan. And also your self-employed health insurance is an adjustment as well. Our IRA deduction, this would be if you were not covered by a plan at work for retirement. Our contribution limit per spouse is $5,500 and an additional $1,000 if we're 50 or older. We have deductions phase outs that start, meaning we can no longer contribute to an IRA if we're single and we make more than $61,000, or on a married filing joint return, $98,000. Our student loan interest is deductible up to $2,500. And here's like our sliding scale as far as deductibility. Here's where it's fully deductible, here's where it's reduced, and after $80,000 or $160,000, it's not deductible at all. And the second, if we flip over to the second page of the 1040, that's where we're going to take a look at our taxes and credit. And a lot of times I have people that come to me and they say, I want to itemize, I just have to itemize. And we go through and we make the calculation and we look, and it's actually better for them to take the standard deduction, because you're going to look at taking the greater of either your itemized total or your standard deduction amount. And they've increased this a little bit for us in 15, but for a single it's $6,300 and $6,200, married filing joint $12,600, and then it was $12,400 in 2014. And the best way I've come to define what the standard deduction means is that is the IRS's guess as far as what you would have spent on medical expenses, property taxes, your mortgage interest, any charitable gifts, or any miscellaneous deductions. And you're going to go through and either accept the standard deduction or show them, look, I actually spent more than this, and then you will take the itemized total. With our, most of our clients that itemize are going to be individuals that have a home and they're paying that mortgage interest and that are charitably inclined. Those are kind of our the big key factors that come into whether or not we itemize. Our medical expenses have to be greater than 10% of our adjusted gross income, so that very bottom number on the front page, which is kind of hard to obtain. Yes?
Question about that. Can you deduct mileage to and from a medical facility?
Yes, you can. It is only 14 cents a mile for your medical, but if you're going to Tulsa or Oklahoma City for like allergy shots or something like that and you're making a lot of trips, you can keep track of those, and those are deductible. And there's other things too. Any elective surgeries, those are excluded, but any surgery or anything that is necessary, that any out of pocket, that is included. And it's the same as far as our over the counter. If we have a prescription for it, yes. If we don't, then we can't deduct it. In our state taxes here and property taxes, this is going to pull from what you have withheld for Oklahoma withholdings. That comes into play here. Our interest paid on only our mortgage, or our if we get any points from financing or refinancing, that comes into play. And if we had less than 20% down, our PMI also is. I know a while back, credit card interest was a deductible expense if you had, but that went away. That's no longer on here. And so we thought the PMI was going to go away, but it's on there for 14. I don't know about 15, but it is there. So,
Premiums for if we have an independent health policy, can that also be
yes,
deducted?
yeah, that can be deducted. And if you have like any outside dental or vision plans, that would go on there too. Glasses, contacts, that also falls on, or hearing aids. I've known to put that on there. Our gifts to charities. If the gift is more than, in cash, is more than $250, they're supposed to send you a contribution statement at the end of the year. If it's something you went to, like the Kiwanis pancake supper or something like that, where you received a benefit, that is not considered a cash deduction to a charity. It has to be a gift that's given where you don't receive anything. So I know with some of them from the foundation, some of that may have like the sweet football tickets and things like that, that in their ticket price it includes food and entertainment, but there's also a gift to the posse. So on those statements it'll say like taxable benefit, and that will be a separate number listed than the actual amount given. If you're doing any non-cash donations to Judith Carmen, Elite Repeat, Goodwill, Salvation Army, you'll want to keep a detailed list as possible what you're donating. And you may want to take pictures. I'm not saying take pictures of every single thing, but maybe you've got a stack of t-shirts, so take a picture of the stack and that. And if you have more than $500 in non-tax donations, you have to file a separate form. I think it's Form 8283, where you have to list the date of the contribution, the place that you made it to, and kind of a general description of the items that were given. And also our miles for our charity miles. If you are doing a bake sale or something and you drive to Sam's in Oklahoma City and pick supplies up for that, those types of things you can keep track of. Again, that's going to be 14 cents a mile, but it's worth keeping track of. If you make breakfast and you take it to church, or you have a casserole that you donate somewhere else, those types of things would also be non-cash donations that you can keep track of as well. Down here, our miscellaneous deductions, tax prep fee, safety deposit box, any investment expenses, unreimbursed employee expenses from your job. This has to be more than 2% of our adjusted gross income. There was a commercial several years ago, and it had some guy, he was a young guy working at a workout facility, And he was so excited because he got to deduct the cost of his shirt, his uniform for his job. Well, more than likely, this guy probably was not old enough to own his own home, and so you can deduct it, but it's not necessarily a benefit for you on your taxes. So he was all excited because he got to deduct it. Well, it's got to be greater than 2% of your AGI, and you have to itemize for it to even be a benefit for you. And some more of our credits are exemptions. They have increased from $39,500 to $4,000 in 15. This may not apply to too many here in the room since we have insurance through OSU, but our excessive advanced premium credit repayment, line 46, this is going to be if you signed up for insurance through healthcare.gov. If that took place, you would have elected, if you were eligible to receive a monthly premium credit reduction or elected a refund at the end of the year. And when you made that computation, you let them know this is what I anticipate my income being for the year. And then you've got to do what they call reconcile the amount that the benefit you received in advance and figure out if that matches up with what you would have told them. So Cassie's eyes are bugging out, but this becomes very complicated, and I think a lot of people, if they signed up in 14 and had coverage through the website for 14, around November they would have signed up for their 15 coverage. Unfortunately for them, they don't know if they made the right election in 14 when they were signing up for their 15 benefits because they haven't filed their tax return yet. So if you signed up for this, if you change jobs, your income increases, you add dependents, you have a change in marital status, then you need to get in touch with healthcare.gov and let them know that so they can adjust your premium you receive. At tax school, there was an example of a family, and they received a monthly credit of $250 for their health insurance. And then at the end of the year, they were eligible for like a $900 refund. But if they had elected a $350 credit, so $100 more, then at the end of the year, they had to pay an additional $270, something like that. So it's very tricky trying to find what that exact number is supposed to be. Our credit for child and dependent care credit, line 49, this is going to be to pay, it does not include summer camp, but it would be daycare, after school care programs. It is a very complex calculation. I'm not even going to walk you through it, but it's based on the number of children, your AGI, and your tax liability. And it's a sliding scale based on your income. So we see at most $1,200 is what comes into play here, which is nothing compared to the cost of child care expenses. If we are between these income amounts, there is a credit that is extended for contributing to retirement. And then our child tax credit, which is different than our child care credit, it starts getting phased out for us at $75,000 a single tax return, and then $110,000 for a married filing joint return.
Is that the AGI, or is that the income when you're calculating 75 single, 110?
I think that's going to be on your AGI. And then just, here's when we're looking at our self-employment tax. The first year that people are self-employed or working for themselves, this is usually something that catches them off guard. When you are an employee somewhere, your employer makes a contribution on your behalf into Social Security and Medicare. When you are self-employed, you are employer and employee. So basically what you're used to as far as your withholdings and everything being taken out of your paycheck, that gets doubled. So this is a tax, our self-employment tax, that, like I said, your first year business on your own, being self-employed, that a lot of people forget to think about. This is also a new item, line 61. This is going to be healthcare individual responsibility. What we have to do with this is mark on the return every member of your family, whether or not they were fully covered by a plan that meets minimal essential coverage is the term they use, for every month of the year. So if you household of 5, you've got to go through and make sure every single person in your household was covered for all 12 months. If not, then there is a penalty that kicks in here. And I have heard different numbers. We've seen different numbers on the returns that we've worked so far in our office. One example, her income was about $50,000, and for her the penalty was about $350. We had another individual, he has a very successful business and has his business income on his return. His penalty was $15,000. So every time I think I get it figured out how the credit is calculated, I hear something new and I feel like I'm back at step 1 as far as figuring out those calculations. So this is going to catch a lot of people off guard, I think, as far as what the penalty will be.
I have a question. So if you have Indian benefits, Indian health benefits, how does that work with that?
You're considered covered. If you have Indian benefits, on the form it says covered through tribal coverage, or there's a few other that meet the definition to say you were covered. At this point, we don't have to provide or submit copies of your insurance cards or anything like that. You just have to mark that you're covered. What starts to make this really confusing is individuals have to start reporting it this year, but our insurance companies outside of healthcare.gov, our other insurance companies, they're not required to file a matching form to yours until 2016 and 2017. So there's going to be a lot of confusion if we try and call the IRS, and because not all parties that are involved are responsible for reporting to the IRS this year. And you have that happen with your W-2 and any other tax form. You get a copy, and then there's another copy sent to the IRS, and what they're trying to do in their systems is match up those forms and make sure you're reporting what you should be reporting. And then right here, our federal income tax withheld, line 64. I may have touched on this in the budgeting presentation. I know everybody gets excited about refunds and that it's really, some people, for them, it's the jackpot to see how large their refund's going to be per year. But when you have that money withheld from your paycheck, you have loaned that money to the government interest-free. And so when they return that money to you, you could have had that opportunity if you adjusted your withholdings. Maybe you could have been putting it in savings and earning a nickel or something, or you could have invested it, you could have paid off debt. Whatever it is you could have done with that money, if you had it in your possession, it could have been something that could have been earning some type of money for you or a benefit to you. But if we wait and we see those large refunds, $3,000, $4,000, $5,000, $6,000, I know in a budget when you're coming up with it, this probably isn't the first item that comes to your mind as far as adjusting, because it's taken out. You don't necessarily have to pay a bill for it. But this is an item I think you can look at as far as adjusting it, and maybe you lower your withholdings to increase your monthly paycheck. And some of my just final thoughts in general, I suggest that people file as early as possible. There's a couple of reasons for that. When we file early, if we have a balance due, so for example, I filed your return this week, you can go ahead and file the return, but the payment doesn't actually have to be made until April 15th. So if you have a balance due, you've given yourself 2 months to try and figure out how to work that into your budget, your balance due. But if I turn around and call you April 10th and say you owe $5,000, you're probably not going to be too happy at me, but you've got 5 days to figure out where am I going to get that $5,000. So if you file early, you can allow yourself time to best figure out how to pay that balance due. Another reason why, and this has been in the news lately, identity theft. With our electronic filing of our tax return, when we submit a return, it gets accepted by the IRS in about 1 to 2 days on their end. If we do a paper copy, it takes about 6 to 8 weeks for that to get updated in their system. So electronic filing, unfortunately, that's been identified as an area for fraud and theft. The IRS will accept the first tax return under a Social Security number. So if our fraudsters, if you will, if they file a made-up tax return under your social security number, the refunds we're seeing they told us it would be about 2 to 3 weeks to expect those refunds, but so far we've been seeing about 7 to 10 days in our office. So they're getting those refunds out pretty quick, and so the fraudulent returns are being filed, refunds are being sent out within 2-week turnaround, and then you come in to try and file your return. It gets rejected from electronic filing because there's already a return out here under your social. And then if you're anticipating a refund, you have to paper copy, and then you have to do additional forms saying you've been a victim of identity theft. And then your refund will take 6 months to a year, probably closer to a year, for you to actually receive that refund. So what you can opt for it to go straight to your bank account or on a prepaid debit card. So what we're seeing with these fraudulent returns is they're loading up on those prepaid debit cards. They're trying to fix this. I don't know if it'll have much of an impact. As far as limiting, only 3 tax refunds can go to 1 bank account. So if you are, filing returns on your children and you have it go to your bank account, if you've got more than 3 coming into that 1 account, you may have to add a savings account. But that's one area they're trying to look at with that identity theft. But the best thing you can do is file early and still electronic file. And like I said, we thought it was going to be a longer turnaround time for refund. That may be the case the more we get into tax season. This other one, be smart with your tax information. Please do not use public Wi-Fi to work on your tax returns, to file it. If you're on public Wi-Fi, anybody else can hack into there. They can get all your information, names, date of birth, socials, wages, addresses, anything that they could use to file a fraudulent return in the upcoming years. And when you go and you pick up your tax return, don't leave it in your car. And also when you get the envelopes in the mail in big red letters all across the front, it says important tax documents inside. So please make sure, hopefully you've received almost everything by now, but make sure you go and check your mailbox every day and you get those forms out of there. Whether it's right or wrong, that's not for me to debate, but being an employee of OSU means that you are a state of Oklahoma employee. And a few years ago, they passed legislation saying all state of employees must be current and up to date on their Oklahoma returns. And so I think somebody in the state office ran the report because we got a whole bunch of phone calls saying, I need to get current on all my tax returns or else I'm going to lose my job. So that's what, if you're not current in your, let's say you need your 2009 tax return filed, you'll receive a letter from Oklahoma Tax Commission saying you're a state of Oklahoma employee. Then you'll also receive a letter from OSU HR saying you're not current with the state. Your termination date is January 30th. You have, I'll say February 28th. You have until this date to get this fixed or that's your last day. So like I said, whether or not it's right or wrong, I don't know, but that's what the rules are. And
3 years.
Yep, 3 years.
So
Yep.
you have to not file for 3 years.
And
they're telling you, file your stuff.
yep, and we've had, and depending on who your manager is, you may get called into a meeting with your manager and your manager says, I received this information, you need to get current on your taxes. Also, if after 3 years is your time frame for you to file a return for a refund. So if you go past those 3 years and you go ahead and get the return filed, so you're on good graces with the state, but if you were due a refund and it's past those 3 years, you can no longer get that refund, no matter what the situations are. So, just stay current with your returns and that type of thing. And plus also, if you're trying to apply for mortgages or lines of credit, most of the time they want to see your current tax return and that type of thing. So are there any questions? I hope this helped some, and I have business cards. These CDs are just a little commercial about our office. It won't help you necessarily with filing of your tax returns. It just gives you a little more about what our office is about. And then I have brochures too, but if there's any questions.
Thank you so much.
You're welcome.
Life insurance is not exemption, right?
It is not a deduction because when you receive the life insurance, it's non-taxable.
Okay.
So no life, we can't deduct it, but the benefit you get from it is not taxable. So
On
Yes.
interest you get on your checkings and savings, you used to be able to deduct like $100 of that on your state. Can you still do that?
like additional withholdings?
Yeah.
Yeah, on your W-4, you can elect, married and one or two, or married withhold at the single rate, but you can also elect that you want them to withhold additional $100.
What kind of interest you get, like on your checking account? Savings.
On that, that is going to get reported as interest income. I think if it's more than $10, I think, then they'll send you a 1099. It may be $50. There's under a certain dollar amount, they won't send you that tax form, and you don't have to report it. But if it's over that amount of interest that they paid, not your current balance on the account, but whatever interest they pay to you over, I think it's $10, then they start sending out those forms to you.
Can't you deduct like 100 of that?
It's not deducting,
Mm-mm.
you're getting a,
On
it
the
was $100,
511C.
I don't know how to say it, but it's, you report it, but they don't exclude it. I mean, they don't add it on
Mhm.
to $100 or something. Like, they don't adjust your income up to $100 for interest income, is the way I understand it.
But if it's interest in Oklahoma, you can deduct that on your Oklahoma return.
Yes.
But on your federal, it's income.
And then, depending on if you get a refund, and depending on your itemized amounts from the prior year, sometimes a portion or all of your state refunds may be taxable the next year. It depends, again, it's one of those crazy calculations that come into play. And it could be all of it or just a portion of it. So, any other questions? So I hope that this helps some. And like I said, I know what it's like to look at this form and be like, I don't get it. I don't know what this is telling me. But the more and more I've worked on this and worked with financial planning, the more and more I've realized the codependent relationship we have with our taxes and our finances, and the opportunities we have with our tax return, that in decisions we can make that will have an impact on us, not just for my tax return this year, but on down the line, like I said, into retirement. So anyways, feel free to email me or call me if you have any questions or anything like that. And thank you. So.